Chaos is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Wells Fargo CEO drops a bombshell as he says pain is coming for all the major banks. And with that, let's over to Bloomberg, where we picked today's story up with a headline: China's stock slump deepens as traders fret over economy's health. And this is interesting because, here in the U.S., we see investors think the equity market can rise even as the economy slows. But what we know is throughout history, as the economy slows, even if equity prices are rallying, well, usually what that means is the floor is about to drop underneath them. And so here in the U.S., we have the notion that the Fed is going to engineer the impossible, that the soft landing is going to occur and the economy is just going to rocket forward. So everybody's piling into the equity market, but China's giving us a warning that the likely path for not only their economy, but the entire global economy and global stock markets is much lower. Sentiment remains so fragile that traders on Tuesday looked past data that showed a private gauge of China's services activity continue to expand in November. Now, keep in mind, we know historically that where manufacturing sector goes, the services sector follows with a lag. Now, it can range between 2 to 3 months. Typically, can it be longer? Absolutely. But in this case, as we look around the world, we see the global manufacturing sector continues to decline. And yes, while we're seeing some uplifting data in the services sector, it doesn't mean it lasts a whole lot longer. And that's why we're starting to see the markets look the other way. Official figures last week showed both manufacturing and services activity shrank during the month. The accumulation of news over the past few weeks would be raising questions on China's economy going into 2024. The macro data has been soft. The big concern over the property slump remains as sales volumes are still very weak. And this is a challenge, and they're likely to get weaker because we talk about, Evergrande's situation, how they're trying to avoid going into full liquidation. If you could only imagine what this means for people that have already purchased properties from Evergrande that they're not completed yet, means they get wiped out too. There's a lot of cases here why we're seeing all this delay from the banks in from the courts in Hong Kong on Evergrande, because China's economy is slowing and nobody wants to be the one that drives it into the ground. And yet we know, well, someone else may have already done that today. As Moody's cuts China's credit outlook to negative on rising debt. Now, this is an issue that we're going to continue to see, not just in China, but all major industrial economies, because in good times, based on Keynesian economics, what you should do is be running a surplus, paying down your debt. And what happened after the pandemic? Well, governments around the world just kept borrowing and borrowing even more. And now all of a sudden, as the economy slows, these rating agencies, this is a private economy, is telling governments around the world that, wait a minute, you're taking on too much debt here and you should have been more fiscally responsible. The challenge then becomes we head into a recession where governments will need to borrow even more money. And the problem here is when governments borrow, they borrow from the private sector. So if the private sector of the economy is expanding, they can handle all of the debt the government wants to borrow. And that allows the governments to borrow more and more money. But in a slowing economy, as governments who are not fiscally responsible, which we can argue are, well, all of them, well, that means they're pulling even more and more money out of a slowing private sector, only causing the private sector to accelerate faster to the downside. As Moody's lowered its outlook to negative from stable while retaining a long-term rating of A1 on the nation's sovereign bonds, China's usage of fiscal stimulus to support local governments and a spiraling property downturn is posing risks to the nation's economy. And so what this likely means is we want to see China stimulate its economy more. And what's going to happen now is as we see further rating downgrades, we're going to see it here likely in the U.S. and other major industrial economies. What it's going to tell politicians and policymakers all around the world is you can't keep borrowing because they get scared. They think rates are going to go up or the value of their currencies are going to go down. It gets them into panic mode, and that means they're going to have to cut their spending at a time the global economy is slowing, and the actual proper move then would be to borrow more money to boost the global economy out of the slump. Challenge we're facing is they're not going to be able to do that. The government pushed back soon after the outlook change was announced, saying it was disappointed with Moody's decision the nation's economy will be highly resilient and has large potential. Well, of course, no government is happy when it gets a downgrade because, again, this means it's time for it to get its fiscal house in order. And we know throughout history, no government wants to actually cut spending. They want to spend even more. Of course, again, the timing of this is all wrong. The impact of the property downturn is well under control, this according to the finance ministry in a statement, and we can only imagine what sort of fantasy that they're living in because we know the developers there are in bad shape. And here we can see one of the leading domestic rating agencies in China said the outlook for the nation's sovereign debt was stable, adding that the government has ample room to control the rise in debt risks when compared to Western countries. Of course, I love it. We're better off than the rest of the world here. No, the reality is they're not any better off. We're all in the same boat. There was too much debt taken during the pandemics, and rather than pay it all down, more debt was taken on top of that. Now the global economy is slowing down, and we are going to end up paying this bill in a big way, and it's going to come at the expense of the private sector economy, driving the world economies into a recession. These ratings downgrades or negative outlook shifts often mark the low in terms of bad news and market sell-offs. I wouldn't see this being the case in 2 or 3 month time. Just from the global macro strategist at Vanda Research, it's hard for these things to get worse than current bearish expectations. It only takes a little to see a tactical rebound or a short squeeze. I would love for this to be true, but the problem is we're in the midst of a global dollar shortage. We're seeing currency shortages elsewhere. The banks have inverted yield curves and money curves and are constricting the creation of credit. No, it doesn't mean that this is the bottom. It just means it's going to get a whole lot worse. Or, as we head over to the UK, well, let's just say we're deferring the good news for a bit. And here we can see the Christmas sales are off to a weak start on delayed spending. Well, of course, that just means that consumers are stuck at home and can't get out and spend. The reality is they just don't have the money to spend. But now I want you to see, you'll notice a shift here in articles. We see delayed spending as if it's coming, it's just not here yet. And that's one of the critical things I want you to see. Hope is starting to fade. As Christmas is off to a weak start for retailers relying on the crucial period to boost their sales, festive spending is forecast to drop a whopping 13% or $25 billion this year, according to a survey by PricewaterhouseCoopers. The cost of living crisis has taken its toll on Christmas spending for many households, and the continued economic conditions are testing consumer resilience. And here's the reality of the situation, and we've talked about this before. It's not that consumers can't handle inflation. The issue is if their total compensation, we look at their not only their hourly average wage, but we also look at the hours worked. If that is not growing faster than inflation, they can't afford it. And what happens then? Just as we predicted, you see discretionary spending fall, and it was likely to happen during the holiday season. But this time, don't worry, it's just being delayed. We're likely to see a prolonged and well-targeted period of discounting as retailers compete hard for a shrinking pool of spend and will need to clear stock. And wait a minute, did that just suggest there's possibly more disinflation or perhaps deflation on the horizon? Well, you got it right. Retailers coming out of the holiday season are going to be in desperation mode. And here we can see why as we look at the U.S. data here. This is advanced retail sales against total compensation, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That in red both on a year-over-year rate change. And we can see that as total compensation goes down, you can see a nice relationship between the two. So too does retail sales spending. And it makes sense because we know, and we're going to get some new data on this on Friday, that the path forward here for total compensation is to go lower, because if companies cannot charge more, they can't pay their employees more. So we've been seeing a downward trend in the consumer price index, which means total compensation is going down. We're seeing a slowdown in the manufacturing sector, which means hours worked are going down. And all this bodes for is a further slowdown in consumer spending. So what's happening in UK, the delay, well, who knows how many years it's going to be on delay for, but that too here is coming to America. And we can see that not just in retail sales, but in oil. As oil holds losses, the Saudi pledge wrestles with the bearish outlook. Of course, the problem here for the kingdom is they need to see oil prices go up or destabilize because, again, everybody's dealing with inflation and they're thinking they can control the price of it. What they don't realize is they need to flood the global economy with oil, drop prices down so U.S. consumers can see their energy bills at least go down perhaps for a change, increase their discretionary spending, and that would increase, guess what? The demand for oil and energy. And next thing you know, you've got a revival. But the problem is, again, inflation has caused everybody's bills to go up. Everybody needs money, and there just isn't enough around. But one way for you to get more of that, well, check out this. Let's do an update on our wheat trade. I got a little bit of my numbers wrong, but let me show you. People say, Steve, is it really that easy to make money trading your reports? And it is, because we talk about how critical the machine positioning is. When you see the machines move, they can drive a lot of money in a short period of time. And what did we see on November 28th? Our machine positioning, because we run a historical overlay. The machines normally don't do that at all, but we do. Telling you, hey, look, there's a big opportunity here in wheat. It dropped to a 55% short position. The following day, it popped up, saying the machines had flipped back as the trend was changing. Now, in the next following days, the machines continued to move in an upward direction. And what happened? Our Momentum Timer Pro, the report that looks at all those technical indicators that people are trying to chart and graph and figure out, what they do. Well, we take all of them, smooth them out, and make it real easy. When you see a daily shift on the buy count, it means momentum in technicals has shifted positive. That happened on December 1st. That would have said buy it open on this green candlestick here. Look at that. It took off that day, gapped up the following day, and was still up as time of recording. That trade is up 4.92%. And here's the deal. You talk about being able to trade for free. You get one good trade and pays for your reports for a year. And right now, 3 people can grab a free month of each report. There's 3 coupon codes. Get them before they're gone, because one thing that may not last, of course, is the kingdom's desire to keep oil prices up. As global benchmark Brent erased an earlier gain, trading near $77 a barrel after dropping more than 6% in the preceding 3 sessions. Saudi's energy minister said that supply cuts would, quote, overcome an expected inventory build in the first quarter and could be continued further into 2024 if needed, suggesting that they're admitting there's going to be an energy build. And why would there be a product build? Because the U.S. economy and the global economy are rapidly slowing down. As two, is there need for energy? And of course, we come right back to the same chart earlier. We look at total compensation still in red, but now let's overlay energy in the form of gas prices, because when people have less money, when their wages aren't growing and they're being pinched by inflation, one thing you can't do, you can't just go to your landlord and say, hey, you know what, can we fix our rent here a little bit? They're probably not going to do that. You don't go to the grocery store and barter and negotiate. So what is your one variable that you can try to control? That's your energy uses. This is what the kingdom doesn't get. Consumers are getting pinched. It tells us demand for gasoline is headed down. You can see as compensation growth falls, well, gasoline prices fall on a year-over-year rate of change to go along with that, telling us, again, demand for energy coming down. The kingdom can do what they want. The reality is crude oil prices are coming down. But now let's talk about the U.S. banking system, because we're seeing things that could topple perhaps even some of the biggest banks in the U.S. Of course, we've heard from the Federal Reserve, who we cannot believe almost anything they say, that the big banks are too big to fail. Well, and they're very full of cash. Well, one of those things is true. The question is, does any of that matter? As the repo market spikes conjure memories of September 2019 as U.S. funding turmoil. Now, if we go back to 2019, the fear was it caused rates to go up. And so some people think, as you see this headline, well, maybe it means rates could go higher. Well, let's take a look back and why things are a little bit different now, and does not mean the same thing. As strain started showing up late last week, the bond buying frenzy that stoked November's U.S. debt rally led to a surge in demand for financing in the market for repurchase agreements, where participants engage in short-term lending or borrowing that's collateralized by government securities. Now, keep in mind, the banking system is collateralized by, when it says Treasury securities, it specifically means T-bills. People do not, collateralize typically with a 10-year Treasury note or a 30-year Treasury bond. You could feasibly, but really that's not something that's done. Everyone wants short-term, high-quality, super liquid T-bills. That's what the system wants. Now, one of the problems you see in the U.S. banking system isn't that the U.S. government doesn't issue a lot of debt. As many of you will argue, we issue too much debt. The problem becomes is we like to take that new debt that gets issued, and after it matures, because we issue it in T-bills, we refi it out to longer terms. The problem is the entire financial system needs a lot of these T-bills, and we starve it of it, and that's what happened back in 2019. A little bit different than what's happening now. The episode conjured memories of the market ructions that occurred in September 2019, even if the latest moves were of a much lesser magnitude. Back then, increased government borrowing exacerbated the shortage of bank reserves that was created when the Fed stopped buying as many treasuries for its balance sheet. Investors had to take up the slack. The real issue going into 2019 is the Fed was doing QE. They were buying T-bills. Overnight repo rates and funding markets, which this happened in China recently, widely relied on Wall Street banks to fund day-to-day operations, rose as high as 10%, suggesting that there was stress in the system. And look what happened. The Fed ultimately intervened by restarting purchases of the securities to stabilize the market. The problem was there wasn't enough of these things in there. The Fed then comes in and buys them, causes rates to go down. And what happened is the system got very fragile heading into the pandemic, and then it nearly blew up. But let me show you, there is plenty of demand for collateral in the system. There's plenty of demand for T-bills. As we look at overnight reverse repurchase agreements, this is cash parked at the Fed, predominantly by money market funds. And look at this, as if government has been issuing more T-bills, well, money markets have been saying, you know what, Fed, we don't need your money. We're going to get it from the market. We believe the rates are coming down. And sure enough, the funding issue suggests a time when the Fed is looking to pare back its balance sheet, a process known as quantitative tightening. Banks' balance sheet capacity will play an increasing critical role. So the gimmick here is everyone thinks that the fact is that because the Fed's not holding as many notes and bonds. Now, mind you, that's what they're rolling off. They're not really rolling off T-bills because you don't own a whole lot of them in terms of their broad balance sheet, that the banks are running out of capacity because it's the banks that are holding all this. And that's not necessarily true at all. It could be foreign investors, could be U.S. investors, could be anyone. It doesn't have to be the banks. But when we get to Wells Fargo, hang tight, because some of this will make more sense. There is a time the banks will want to hold these, and maybe we will have capacity issues, as Wells Fargo CEO is suggesting. And this is happening against a backdrop of increased government borrowing due to swelling U.S. federal deficits. So the case is being made here is there's just too much debt, and the banks can't buy it, and the banks need to buy it. Well, guess what banks really prefer to have? There's a lot of T-bills. They do want some notes. They do want some bonds, but they predominantly want T-bills. They do want that. They want a diversified portfolio of them, and they can absorb them. And guess what? With rates being up, guess what U.S. consumers want too? They want the high interest rate as well. This might be a dealer balance sheet story more than a shortage of reserves shortage. This from the head of U.S. interest rate strategy at Societe Generale. A bunch of collateral consistently hitting the markets over the last few months, heading into month end, is probably contributing to the spike in repo. There you gotta get the real story here. Is there's just an issue. This is a balance sheet story more than it is a shortage of reserves, because in terms of reserves, what we consider a reserve looks exactly like a T-bill. The problem some of this is that cash is going into CDs and other things, being backed by different stuff. The problem is the banks are dealing still with a shortage of collateral. This is a problem, and they can't absorb all of it. And there's a problem, as Wells Fargo CEO now says, that the asset cap will cause pain. Well, eventually, but maybe sooner than he thinks. The asset cap today is not a material limitation just because of where trends in deposits and where loan demand is. This from the CEO of Wells Fargo. It has been, and it will be again. So what you need to understand about Wells here is they're limited in size. So when I hear someone say, you know what, I've got all my money at Wells Fargo, and they really irritated me, so I'm going to show them and move my money. Well, guess what? You're doing them a huge favor, because the government is limiting how big the bank can get. And that's a problem, because in the next crisis, guess what will happen is people will flood to cash and cash equivalents. They'll want to deposit their money in the bank, and Wells Fargo, they can't handle it. They can't accept it because they're capped. That's one of the problems with JP Morgan Chase right now, is they're so big, they're getting too big. And so one of the issues here is, will the government pull off the cap on Wells Fargo? Because if they do, Wells Fargo has the immediate capacity to buy hundreds of millions of dollars worth of U.S. Treasury securities. And guess what the government might need them to do is start buying some of those and absorb some of the cash as everyone floods into cash. And guess where they're going to come out of? The equity market? Now the small and mid-sized regional banks. The fourth largest U.S. bank has been hobbled by a Fed order limiting its size at the end of 2017 for more than 5 years, longer than the CEO has been there. The punishment is tied to a series of scandals that bank began with fake accounts 7 years ago, and Wells Fargo executives privately expect the restriction to stretch into 2025. But if there's a recession, maybe watch out. This restriction could be waived because, again, the government will need the banks to absorb cash, maybe buy up some of these smaller banks. Wells Fargo, not in a position to do that. In a wide-ranging conversation, the CEO said the economy is stronger than expected. Consumer spending is consistent. As for business, with all the talk of rising rates and potential downturns, they're positioned extremely well. This is true. Wells Fargo is all of the banks. They're actually well positioned. They just can't absorb any more money, and this is going to be an issue because they're going to need to. The government's going to need them to buy bonds. This is all going to happen, and this is a warning because you start looking at policymakers are going to take a look at bigger banks like J.P. Morgan and say, you know what, they're getting way too big here. Something were to happen, it could cause a systemic collapse of the banking industry, and that means at some point Wells Fargo's cap is going to have to be lifted because, as he's right, pain is ahead, and we're seeing that in the data today. As U.S. job openings fall to the lowest since 2021 as labor market cools. Now, this is Janet Yellen, former Fed chair, now the Treasury chief's favorite statistic is available position decreased to 8.7 million from a downwardly revised 9.4 million the prior month, and hiring edged lower. Layoffs were little change. And why the JOLT survey matters, or job openings and labor turnover survey, is because when job openings go down, well, guess what comes next? Layoffs. You got it right. Let's take a look deeper. The so-called quits rate, which measures voluntary job leavers as a share of total employment, held for a fourth month at the lowest level since early 2021, meaning people are no longer confident that if they leave their job, that they're going to get a better job or even be able to hold on to that job when things go wrong. A moderation in quits may imply Americans are feeling less confident in their ability to find other jobs in the current market or reflect a smaller wage premium on offer for job switchers. And with employers scaling back hiring and wage growth decelerating, it's unclear how much longer the job market will underpin strong consumer spending, just as we've warned. And here's the data that shows that perhaps the U.S. equity market, remember we started the show talking about how China's equity market's following the data down, and yet U.S. investors are pinning their hopes on a soft landing. Well, this chart says U.S. equity market likely headed down. Here you can see job openings and labor turnover survey against the Wilshire 5000 price index. And we've been wondering, we mentioned last month when we saw the data, that is the trend in the JOLT survey going to continue to fall against a rising equity market, or is it going to jump higher as employers look to see stock market wealth flowing into their doors? Well, what we're seeing here now is job openings head lower, meaning the equity market, the path likely to the downside. And as far as unemployment claims, look for them to head higher in the weeks and months to come. Here we see the 4-week moving average of initial claims in red overlaid against the JOLT survey. And as employers cut those job openings, well, the next thing that follows is people getting pink slips. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.